Hello guys, Lex here. Welcome to this video. So today we're going to talk about some of the patterns that didn't really work in the last couple months. The most recent tickers that we have will be OCEA, BLPH, couple bounce short and gap up short. So I'm going to go through the criteria of why those tickers didn't really work when they fit, I would say 50% to 70% of the pattern. By the way, we have a new course that just came out. So make sure to check it out, the new course. It's going to be really helpful for the new markets. Other than that, let's get into the video. All right, so we have BLPH right here. As you can see that we have one individual resistance right here, which happened around January 5th. Overall traded about 60 million volume. So it's a solid resistance. Let's go into the intraday chart generally. On this day, you can see consolidated around 2.2, highest is 3.5, neutralized area 2.2-ish. Now let's go into this day, which happened as a bounce short, March 6th. So whenever you're looking at a resistance to short into, typically you want to look for a consolidation. The consolidation is around 2.26, which is right about here. But you can see before 2.26, it didn't really trade any volume. Volume didn't really come in until around 3.2. That's right at the resistance area. I would say at the top of the resistance. So whenever you see that there's no volume trading when it's heading into the resistance, that typically means that resistance is likely to be broken. Over here, you went through about 60% above the resistance. That doesn't really mean the resistance is not active anymore. It just means that, especially when the stock starts to spike and slow grind between midday into the afternoon, the bounce short winning percentage gets reduced by 50%. So for BLPH specifically, this is a failed bounce short. So I would recommend in the future, avoid the 12 p.m. bounce short into the biotechs. Especially in this biotech industry, bounce short and gap up short, their statistics are a little bit different compared to the normal gap up short and bounce short. And also going into the midday and afternoon, winning percentage will get reduced again. So in the future, I would definitely avoid these type of tickers, especially when the neutralized area is really high, that the neutralized area is above the consolidations and doesn't really trade any volume. You will need at least 10 million shares needs to be traded before the ticker is tradable. So total amount of dollar needs to be traded, it needs to be 30 million. So if the stock is around $3, it needs to trade 10 million shares before it's actually tradable for you to size in. Other than that, if it's trading a couple 100K volume, then it's not very ideal. Now go into LUNR that happened last week, specifically February 23rd. This is the day I really wanted to short into. We can see we formed semi-consolidations around 112, 120-ish. And the gap down to the second day, because the yesterday only traded around 3 million shares, and today the overall amount of share only traded is around 1 million. Whenever you are looking at these type of double day intraday top, you're looking at a pullback and go ahead and come back and consolidate, test the resistance around 120, then fade again. But in this market, everything it seemed like really weak and the volume is not there at all. First of all, let's look at the maximum reward. The maximum reward on LUNR on the consolidation, which I think is around 30. So right here, 30 to 40. Typically you want to cover right before the consolidation, right? If you chased, let's say around 80, 70, then your maximum cover point will be around 60. So that's not a great reward, but there's no actual strength at the market open, so there's no opportunity to size in, because the highest candle that traded it was 60K candle or 40K candle. So it's pretty much impossible to size in and with size without causing the share to panic. If you're sizing a decent amount, you will get really bad executions. So especially for LUNR, these type of trades doesn't really happen that often. You dipped under the 40 area support. So going into the bounce short March 9th, came all the way back up to the 19, which there's no actual solid individual resistance traded between 14 to 150. There's no actual volume. Everyday volume was around 3, 4, 1 million. On this day, traded about 6 million. So whenever you see this type of ticker tends to come back in the midday, I would avoid on the first screen day when they're trading much more volume compared to before, and only trades these type of bounces into the second day when they go back and test the resistance again. So right here, I took a little bit size around 19, covered around 14. Even though on these type of trades, the overall gaining percentage starting from $10 is about 80% overall extensions. Back in the days, we don't really short anything that's have 80% extensions. We're looking at 180% to 200%. So the market has definitely shifted into a much lower range. Lower range tends to create much bigger squeezes. So that means you have to size it much smaller than before. And make sure pay attention to the volume, because we're dealing with really low liquidity. And if you're sizing much bigger compared to liquidity, then you are likely to get squeezed. Especially with low flow, those are not really fun to deal with. So that'll be the recap for this video. And make sure to check out the link below for the courses, and I will see you guys in the next one.